Welcome to Taking Stock for the week ending the 15th of July 2022. I'm Kien, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to you all things share markets. Great to have you on board again, Jace.
Thanks again, Kien.
But before we get started, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Remember, shares are volatile, so any charts and tables presented should not be relied upon as a guide for future performance. Well, Jace, once again, inflation and interest rates continue to drive market volatility, with the annual US consumer price data coming in at 9.1%, ahead of market expectations of around 8.8%. And with the strong inflation data on the 26th to 27th of July, the US Fed is expected to raise its cash rate by 75 basis points. And that's going to take the cash rate to a range of 2.25 to 2.5%, with rate rises of around about 50 basis points to follow thereafter as well. Meanwhile, bond markets are concerned that the Fed may tighten the credit too aggressively, and this could trigger a recession potentially next year. And this is explained with the chart on screen, which shows the difference between the 2-year treasuries and the 10-year treasuries. A negative value on the chart implies an inversion in the yield curve and has historically preceded US recessions, which is highlighted in grey.
That's a good point, Ken. I mean, as with all these talks around interest rates, at the end of the day, no one really knows where things are going to go. Remember, inflation figures are lagging indicators. So the short-term outlook points to a deceleration in inflation from here. In particular, energy prices have reversed in July on the back of falling commodity prices. And here in Australia, the economy remains strong, with unemployment falling to 3.5%, which is its lowest level since 1974. To prepare ourselves for a potential slowdown in the economy, we can apply strong risk management strategies to help mitigate these macroeconomic risks. So invest according to your stage of life, your net worth, and maintain a well-diversified portfolio of at least 15 stocks, and concentrate on financially healthy companies that may be able to weather the challenging periods ahead. Remember also to look for opportunity amongst the volatility.
Yeah, those are wise words, Jason. Speaking about wise words, legendary investor and business partner of Warren Buffett, Charlie Munger, has recently mentioned that investors should look beyond the inflation threat. He doesn't pay attention to macroeconomic trends, and he ignores it like the weather. And although rising interest rates could have a significant impact on stock prices, he has been using this time as an opportunity, with Berkshire Hathaway buying billions in stock in recent months. Charlie is also highly skeptical of speculative asset classes such as cryptocurrency, and has labeled the crypto craze as a mass folly. Instead, he said that people should invest in companies that are generating real cash.
Sage words. And no doubt the speculative mania across cryptocurrencies and other speculative stocks are beginning to unwind. We have been warning our investors about the buy now, pay later sector for over a year now. And this week, the sector continues to be in the spotlight, all for the wrong reasons. And this is after credit provider Zip announced that it would terminate its much hyped takeover for payments platform Sezzle. So it was no sizzle after all, Kien. Both companies are in poor financial health, and the merger has led to an accelerated cash burn for Zip investors, given that Sezzle is loss-making. Unfortunately, many investors who bought into the hype may have suffered losses.
Yes, Jason, that is a good case study on the importance of financial health. But turning our attention now to our star stock highlights, wealth platform provider Netwealth, they released their June quarter update, which revealed a 3.4% decline in total funds under administration over the quarter. And that was due mainly to unfavorable market performance. However, this was partially offset by 2.7 billion in fund inflows, which brought the full year 2022 inflows to around 13 billion. And that was in line with company guidance.
And also in recent months as well, Kien, Netwealth has been sold down on the back of the rotation away from quality growth stocks. But we believe the recent announcement provides a conviction on the opportunity. Earnings have also been revised higher as the company grew the number of accounts by 4% over the quarter. And in addition, rising interest rates should lead to higher margins from its interest-bearing client cash accounts. However, trend-sensitive investors should remain on the sidelines until a bullish signal is triggered on either the SD Max or the SD30 TSR.
And in other positive news, Objective Corporation, they released their financial year 22 result, which was unaudited. Now, for those not familiar with the story, Objective provides software used by local governments and enterprises to help them manage information and improve governance and also aid in decision-making. Now, through their subscription-based model, Objective Corp has been able to forge thousands of customer relationships, many of which have existed for over 10 years. The company derives 77% of its revenue from Australia and 13% from New Zealand, and also 10% from the UK.
From the announcement yesterday, the company's performance over FY22 appears in line with consensus expectations, although we have to remember that there's only one analyst covering this stock. Now, the return on equity has accelerated over FY22, and as the company generated strong revenue growth on the back of its fixed cost base. The numbers suggest that the company is likely to be retained under our coverage when it reports in August, with the share price weakness over the last few months representing a potential opportunity for some investors that are comfortable with the active risks. Once again, trend-sensitive investors should wait on the sidelines until a bullish signal is triggered on the SD Max or the SD30 TSR.
And it's also good, Jace, to see a strong alignment of interest with shareholders, with the CEO, Tony Walls, holding a 65% stake in the business. Also, reassuringly, he's also modestly paid for 1.4 billion market cap stock. And speaking about opportunities, logistics software provider Wisetech, they lifted their full year earnings guidance, with earnings coming in at around 9% ahead of market consensus. Now, these events help investors provide conviction in the opportunity, following, remember, the rotation away from growth stocks over the last 6 months, which has seen some of these stocks fall, these high quality stocks fall.
Another company to provide a trading update on FY22 performance was Jumbo Interactive. The result appears in line with consensus expectations, although the earnings margin for FY23 appears slightly below estimates. Please review our analyst commentary for further details.
And looking ahead, none of our star stocks are due to report, and no star income stocks will go ex-dividend. However, our resources companies are beginning to release their quarterly updates. Rio, for instance, just released their second quarter update. And although iron ore production was in line with guidance, earnings could be weighed down by that volatile iron ore price. Next week, though, Lynas and also BHP should be releasing their updates on Tuesday, the 19th of July, and also gold miner Northern Star on Wednesday, the 20th of July.
All right, thanks for that wrap up, Kien. And over to technical alerts. For those that are highly trend sensitive, Grange Resources turned bearish on the SD Max, while Aristocrat and ResMet turned bullish. Interestingly, for moderately trend sensitive investors, Lynas triggered an exit on the SD30 TSR. Positively, Lovisa and Adairs triggered a technical re-entry after a brief rally in retail stocks.
Earlier this week, New Zealand telco firm and Star Growth stock and Star Income stock, Spark New Zealand, they sold 70% of their telco business to a Canadian pension fund for $900 million. The sale will enable management to conduct a potential capital return as well as invest in future growth opportunities. This means that they could increase dividends or undertake a share buyback for investors. They could also reduce debt levels in an environment of rising rates. But many investors may be wondering whether the sale will lead to a loss of future earnings for the business in the longer term.
It's a good question, Kien. From what we understand, the earnings contribution is quite minor, at around 2% of earnings. So as such, the divestment should not be a drag on the group's earnings and dividends in the future. On Stock Doctor, the payout ratio is over 100%, but this is not unusual for an infrastructure type business like Spark. The payout ratio is calculated on earnings, which accounts for non-cash items like depreciation, and this can be quite elevated for an infrastructure company like this.
Yes, and the more important measure really is to look at free cash flows, which remain above dividend payments over the next 2 years. And with the sale of a telco, there is now potential for the gross dividend yield of around 5% to be even higher in coming years. Note that the stock goes ex-dividend in mid-September, and 2 months is usually a good window to prepare for the dividend. But Spark New Zealand has a significant amount of debt, and this is outlined with a net debt to equity at around 123%. And yet, the company is financially healthy. So what is the reason for this, Jace?
So if we take a look at the financial health model in Stock Doctor, you can see that most of its balance sheet ratios are weak. And this is due to a combination of high percentage of debt, intangible assets, and also lease liabilities. Fortunately, this is offset by a strong and stable profitability and cash flow ratios, which are generally tied to the company's strong market position, superior network coverage, and also its extensive infrastructure assets.
So to conclude, despite the debt, the stock is a defensive, high-quality play in this environment. With the reporting season fast approaching, an ideal question this week is, how can Stock Doctor help investors prepare for the reporting season? And with so many companies reporting their results over the next month, it can be quite difficult to track everything, but Stock Doctor makes it quite easy. First and foremost, ensure that your portfolios are up to date within the portfolio manager. Then you can set up alerts to monitor stock announcements and changes to the fundamentals. To set up the alerts, navigate to the alert manager under tools, create a new alert or a multiple alerts, enter company codes and select from 4 categories with some key ones, including star stock changes, financial health rating changes, you have earnings revisions there, price sensitive announcements, days until ex-dividend date, and technical triggers like the SD30 TSR. Now, alerts can be processed intraday and will notify you within Stock Doctor via email. It's really your choice.
Aside from the alert manager, there is also the corporate calendar, which provides a window into which stocks are reporting over the next month. Here, you can also access report dates, AGM dates, and ex-dividend dates. Just be a little bit careful, as if there's an asterisk next to the stock, it means that the date has not yet been confirmed by the company and is estimated by our system. Also in this selection, on the menu on the left, includes options to filter on companies, watch lists, and event types.
And at the individual stock level, you can also access the upcoming corporate events by clicking on the date item at the top of the 9 Golden Rules page. Here you can also see a list of alerts and whether this stock is in your watch list or your portfolio.
And last but not least, the reporting season is when our financial health model really takes the shine, allowing members to quickly conduct due diligence on a company after the release of its results. No other financial health model out there has been backtested with a 95% success rate in helping our investors avoid corporate catastrophes.
And these tools will help you stay on top of your portfolio during the reporting season. And as always, feel free to contact us if you need any assistance. Also, be mindful that the research team will be extra busy analysing the results, but we will endeavour to return your call in a timely manner if you have any questions. Anyway, Jace, that's all we have time for today. And also a reminder to our members to attend our Lincoln Live webinar on Monday, where our Chief Investment Officer, Tim Lincoln, our Portfolio Manager, Matthew Swartz, our Stock Doctor expert, Rob Manfrey, and also myself discuss the market and answer your questions on stocks. To summarise, inflation and interest rates continue to rise, but our economy remains resilient with unemployment low. Invest like Charlie Munger, ignore the macroeconomics, be wary of speculative investments, focus on finding financially healthy businesses that are generating strong cash flows to ride through the market cycle. Take care and have a happy, healthy and prosperous week, everyone.